Since the 4% rule for retirement income was first worked out in 1994, a ton of variations to the rule have sprung up as the maths was adjusted, reworked and fiddled with to fit the world as it changed over the years. The reason people worry so much about the accuracy, or not, of the 4% rule is that so much rides on it being correct.
The rule says that retirees can safely spend 4% of their portfolios in the year they retire and can continue spending this amount adjusted up with inflation every year for the rest of their lives. But if the 4% rule is wrong, you could find that your pot runs dry mid-retirement. Is the 4% rule dead, as many are saying? The rule's creator, William Bengen, said as recently as 2020 that the rule should be loosened to a 5% rule given we were living through a time of very low inflation and the stock market was ticking along strongly. His low inflation remarks have since aged like milk.
Now that inflation is running at 9% and rising, and stock market returns are forecast to be low for the next decade, it's sensible to question how a retiree could hope to keep ahead when real investment returns, after deducting inflation, are now likely to be negative. With inflation running amok, does the rule need to be adjusted to something like a 3% withdrawal rate, requiring you to have to increase your portfolio size by an extra few $100,000?
We don't think so. The 4% rule was basic in its approach to retirement, looking only at the movements of the markets and not at the wider financial circumstances of real people. There are a number of factors not considered by the rule that make a 4% withdrawal rate seem, if anything, too stingy. What are these? Let's check it out. And by the way, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. There are thousands of stocks to choose from and they charge zero FX fees when you trade.
You only incur FX fees when you deposit or withdraw funds, rather than every time you trade, as you do on many other apps. Stake are giving away a free US stock worth up to $150 to everyone who signs up and funds within 24 hours via our offer link, linked to in the video description below. 6 things that rescue the 4% rule. The 4% rule represents the safe withdrawal rate in a worst case scenario. The rule was created using historic data on stock and bond returns over the 50-year period from 1926 to 1976, focusing heavily on the severe market downturns of the 1930s and early 1970s. Somebody withdrawing 4% from their portfolios at the bottom of the worst ever US stock market crash in 1929 would still have successfully made it through retirement. But let's suppose for a moment that the 4% rule, which is based on history, is not fit for the future.
The most pessimistic members of the FI community come up with safe withdrawal rates around the 3% mark, so let's run with this assumption. If market forces meant you had to decrease your withdrawal rate mid-retirement to 3% to stop your pot depleting, would you have to go back to work? Your retirement income would need to be a quarter lower than what you'd planned for. For instance, £1,500 a month instead of £2,000 a month. Let's look at 6 reasons why this is not necessarily a problem.
Number 1. Expenses can be flexible. First up, just because you need a 4% withdrawal rate on day 1 of retirement, it doesn't mean you'll need that much moving forwards. This chart by JP Morgan shows that people spend less as they age in all areas, with the exceptions of healthcare and donations to charity. But as this graph is looking at American households, we Brits might get away with spending less on healthcare than the Americans do, due to the UK's NHS, which is, after all, free.
The households studied all had between $1 million and $3 million of investable wealth. That is freedom fund money, not tied up in a house, and so are the types of people who might use the 4% rule. The difference in spend between a 45-year-old and an 80-year-old, for instance, is a 30% drop. And if you've paid off your mortgage, presumably most of this housing wedge disappears too.
You will also naturally adjust your spending down as you hear bad stock market news. Even if you don't intend to follow the financial news in retirement, you can hardly miss a crash as everyone you know will be talking about it. One way you might react could be to skip a holiday that year or go to the Lake District instead of Canada. Maybe you keep your car running for an extra couple of years before trading it in. Or maybe you don't buy that conservatory you'd been setting cash aside for and spend that money on a few years' groceries instead.
Number 2, your house. Most retirees will at some point have a house that is fully paid off. The mortgage will stop being an issue, but more than this, the house itself is a kind of off-balance sheet asset to your retirement portfolio that you can draw upon in certain circumstances. You normally can't spend your house, but there are at least 3 ways that money can be released from your home to help finance a struggling retirement.
First up, there are all the obvious combinations of downsizing and relocating to cheaper areas. Next up, you could release equity from your home. The usual way to do this, if you are over 55, is to use a lifetime mortgage, which gives the bank the ownership of part of your home in exchange for perhaps hundreds of thousands of pounds paid into your bank account, and you get to stay in the house for the rest of your life. You could live off this money, or you could add it to your investment portfolio to bulk it up.
Lifetime mortgages often allow you to defer payment of any interest until the deaths of both you and your spouse, whereupon it's all settled from your estate. In short, this is a powerful option for retirees who aren't overly fussed about leaving such a large inheritance behind.
Finally, you could sell up completely and rent. Say you get to age 70 and the 4% rule begins to show signs of failing you. If you expect to live for another 20 years, does the maths work? 20 years rent may cost you £240,000 at £1,000 a month, while your house might be sold for £500,000, leaving you 260 grand of extra spending money, which could be added to your existing investment portfolio.
Number 3, the state pension. As we've said many times before, there is absolutely no guarantee that the state pension will still exist in its current form by the time you retire, especially for millennials and those younger, so you can't rely on it. As it is now, the state pension is currently worth around £1,600 a month for a couple, or 19 grand a year. It's an incredible bit of free cash that you definitely shouldn't plan to get, but are instantly enriched by if you do get it.
If your household's retirement portfolio is £1 million, meaning the 4% rule provides you with a £40,000 inflation adjusted income each year, then nearly half of this burden is instantly relieved by the state pension. Feel free to drop to a 2% rule if you want to.
Number 4, your own mortality. You are going to die. This means your pot does not need to last forever. This is not much use to you if you are retiring early at age 40, since you do need it to, in effect, to last forever. But if you run into trouble with the 4% rule in older age, you might decide that you don't mind depleting your capital off your portfolio slightly more than what is strictly sustainable.
Number 5, barista fire, supplementary part-time work. This is one for the younger early retirees who don't yet have the luxuries of a paid-off house or an imminent state pension, but still have the energy to pursue some paid work. If the market was tanking and you had serious worries about your portfolio, there's no reason you couldn't get a temporary part-time job. This might just be for 6 months or so, working a couple of days a week to supplement your income so that you don't feel pressured to sell investments when the market is crashing.
Or it might be that you pursue some kind of low-stress paid work in retirement, not out of necessity, but of your own free will. Maybe you find something you're passionate about in retirement and choose willingly to continue working in some capacity. We think most early retirees will find they do still want to work a little bit, maybe after a couple of years of travelling or chilling when the novelty of retiring early is worn off.
Many people find structure in work, and if it's just 1 or 2 days a week, it lacks the sting of a full-time grind, while removing a lot of pressure from your freedom fund. An example is working a couple days a week in a dog shelter if you're an animal lover for maybe £600 a month. It would be totally different from your high-pressure career as a lawyer or a nurse, and enough money to supplement a flagging investment income.
Number 6, a flexible fire date. Sequence of return risk is the biggest risk facing your retirement pot. It is the risk that the first 5 years of your retirement coincides with a market downturn. This could look like a £1 million pot being reduced to say 600 grand and thereafter being too small to sustain a retirement income. History says that in most cases the 4% rule should still hold, but if you wanted to make sure, you could simply be flexible with your retirement date. Yes, you wanted to retire at 45, but is retiring at 47 so bad if it means you get to ride out a market crash without having to sell any investments?
The bad economic outlook is temporary. Most of the talk of the 4% rule being dead comes from short-termists who look at the current high inflationary environment and conclude that this is the new normal. But the period of history that Bengen looked at in his original study of the 4% rule included 5 periods where inflation was higher than 5%, which all came and went. Real portfolio returns may have taken a beating during these times, but soon recovered and grew during other years. Likewise, high inflation may be with us for a couple of years, but will soon go away again.
And what of the gloomy forecasts from a whole bunch of investment analysts that the next decade will be one of lower returns? Well, if the forecasters were good at predicting anything, they would have seen the 2008 crash coming or told us about the market boom that followed the coronavirus. They foresaw neither. You may as well ask for a palm reading than ask a stock market analyst for an accurate prediction of the next 10 years. And in any case, what does a decade of lower returns matter if the next century performs anywhere near as well as the last one?
The 4% rule is not dead. You don't need all of the 6 safety nets to come into play for the 4% rule to be a success. You might not even need any of them. Indeed, they wouldn't have been needed for the rule to work over the last 100 years since 1926, and you might treat the boosts from some of these buffers as additions to your disposable income. And if you're worrying about having to work an extra decade so your pot is big enough for a 3% rule, you might be being overly cautious. Isn't the biggest risk a life not lived?
Question of the day, would you ever take equity from your home to prop up your retirement, or would you be willing to go back to some kind of paid work? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.